Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to discuss two big tech companies who are estimated to be cheap or undervalued at their current share price. And right now, there is a ton of fears of inflation hitting the markets very soon. And investors are transitioning out of the tech sector and moving their capital into safer consumer, real estate, or even commodities to help combat inflation. So right now, we're going to discuss two big tech companies that may be a nice buy even during times of inflation, because these are the companies with strong balance sheets, incredible revenue and cash flow, and own a market-leading position in their industry and should continue to operate. They have pricing power and will continue to grow even throughout times of inflation. And like I mentioned, both of these stocks are estimated to be trading below their fair value and may become a great opportunity to buy now even at their current prices. So before we take a look at these two stocks, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first big tech company that's considered cheap and undervalued right now is ticker FB, which is Facebook. They currently trade for $327 per share, and over the past 12 months, they have grown by just under 40%. And right now, the company has a market cap at $920 billion and trades with a forward PE of only 25.2. So for a big tech company that's posting incredible year-over-year growth numbers with no signs of slowing down, to be trading with a forward PE ratio of only 25, which is just slightly above where the overall market is trading at right now, I think Facebook is considered cheap in terms of their current valuation. And if we also take a look at a report from Morningstar, who is one of the most trusted and respected names in the capital markets, they've set an estimated fair value per share for Facebook at $368. So compared to where they are today, they believe the company's trading at an 11% discount from their estimated fair value and have the company ranked as 4 stars, meaning it is undervalued. So that's a great sign that now may be a great opportunity to buy some Facebook shares when they're trading below their estimated fair value. And of course, if we take a look at a second report from different analysts, they used a discounted cash flow analysis. And if we jump over to Simply Wall Street, their DCF calculation gives Facebook's estimated fair value per share at $462, meaning the company is trading at a 29% discount from their estimated value at this current point in time. So two different calculations using different metrics. One takes in a bunch of different factors on Morningstar, and Simply Wall Street uses a DCF calculation, and both are showing that this company is undervalued or considered cheap at this current price point. And even for a company as large as Facebook, worth $920 billion, they have no signs of slowing down. And we can see that over the past quarter, their revenue grew 48% year over year, driven by higher price ads. And Facebook, no matter what's going to go on in the world, advertising will always take place, and Facebook has become the leader in that industry. And we can see over the past quarter, they generated $3.30 of EPS, crushing the expectation of $2.37. And their total revenue came in at over $26 billion, once again beating the expectation of $23.67 billion. So the company posted an incredible quarter of massive revenue and earnings growth. And why I believe this company will still be dominant even through times of inflation is because they control the market all around the world, and across all of their different social media platforms, they have over 2.85 billion monthly active users. 2.85 billion monthly active users is incredible to even imagine. Every single month, a large portion of the world's population is using a Facebook platform. So they have eyes at over 25% of the world's population every single month, and that's almost crazy to even say out loud. And we can see over the long term, that number continues to grow. So even though some people believe Facebook is dying out as a brand, the numbers are showing the opposite. every single quarter, more and more people are using Facebook services. They're doing a great job of expanding their different platforms. And over the long term, I see this trend continuing as more and more individuals get access to technology and have the ability to use a Facebook platform. And we can see that the company's revenue is growing year over year as well. So we can see Q1 2019, $15 billion. That grew to over $17.7 billion Q1 2020, and then a major acceleration to over $26.1 billion in Q1 2021. So every single quarter, they're growing their revenue year over year, which is a fantastic sign. And their revenue is coming in from all around the world. So this is another reason why I believe even throughout times of inflation in the United States, this company will still be very strong because their revenue is not solely reliant on one single nation. And we can see that the US and Canada over the past quarter made up less than half of their total revenue, and a large portion of their sales came in from Europe, Asia Pacific, and of course, the rest of the world. And we can see all the other segments continue to grow and expand pretty equally across the longer term. And with Facebook, because they're a software-based company, they don't really make any products, they don't have really much high cost of goods sold, the company is very profitable. And net income over the long term continues to grow as well. And we can see if we take a look at the 4-quarter time periods every year, a nice upward trend. Starting 2020, continuous upward momentum as well. And taking a look at the Q1 numbers for the past 3 years, $2.4 billion of income back in Q1 2019, up to $4.9 billion Q1 2020, and then up to a massive $9.49 billion of net income in Q1 2021. So even for a company worth just under $1 trillion, their earnings number continue to grow exponentially year over year. And if we jump over to the company's financial statements, we're going to get a 5-year picture of their recent performance. So back in 2016, they generated over $27 billion of total sales. And just in a 5-year timeline, they've just under 4x their total top line to $94 billion of total revenue in the trailing 12 months. And every single year, it continues to grow like clockwork, which is absolutely phenomenal. And taking a look at the bottom line, we see a very similar picture. $33+ billion of total profits in the past trailing 12 months, meaning Facebook has a net profit margin right around 35%, which is absolutely incredible. A 35% net profit margin is fantastic for such a large company, and this is one of the reasons that even though at times of inflation, Facebook may still be a strong buy. Highly profitable, they have pricing power over their advertising platform, they have over 2.8 billion monthly active users that even through times of inflation, I believe the company will still post some very healthy financial numbers. And if we take a look at their balance sheet, again, a very strong position. Over $64 billion of cash sitting on hand in total current assets of $77 billion. Compare that to short-term debt of only $12 billion, which is incredibly tiny, and the company has no long-term debt. I think Facebook has one of the most healthy balance sheets in the world, and we can see zero long-term debt. None. Over the past 5 years, Facebook has not carried any long-term debt, which is absolutely phenomenal, and they're using the cash generated from the business to fund their growth, do research and development, and continue to expand their product line. And overall, the company's total debt comes in at only $29.8 billion. So currently, with a cash pile of over $64 billion, they can pay off every dollar of liabilities on the balance sheet, still have over $30 billion sitting in cash, and continue to operate as one of the strongest companies in the world. And right now, their equity grows year over year as well, and currently sits at $133 billion, which is absolutely fantastic. And of course, like we saw, no long-term debt, meaning the company must have incredible cash flows, and of course they do. Jumping over to the cash flow statement, over the long term, the company's done a fantastic job of growing their cash flows to over $24 billion in the past year, and going forward for many years in the future, analysts have some big expectations and are forecasting between 23 and 24% annual expansion in the share price, And right now, Facebook is considered a slight strong buy with a current share price of $327, which is below the 12-month expectation of $385 per share. So analysts are showing some upside over the next 12 months, even throughout the risk of inflation coming throughout 2021. So Facebook is the first big tech company to take a look at right now. Although they are trading near all-time highs, the stock as a whole may consider to be cheap or undervalued at this current point in time. A forward P of only 25 for a company as strong as Facebook, they're being valued close to the overall market, but I do believe Facebook's going to outperform the average of the S&P 500 over the next 5 years. And according to Morningstar and Simply Wall Street, they are undervalued using any type of calculation, whether it be a DCF or a ratio valuation metric, to come up with an estimated fair value for this company. So definitely worth taking a look at. One of the big names in tech, we all use their services. Over 2.8 billion people use them every month, and I definitely think this is a company worth taking a look at right now. And now we're going to continue on into the second big tech company that's considered cheap or undervalued at this current point in time, and that is ticker GOOGL, which is Google. They currently trade for $2,380 per share, and over the trailing 12 months, they have grown by 67%. And at this current point in time, the company has a market cap at 1.6 trillion and is trading with a forward PE of 27. And relative to the overall market, I believe a 27 forward PE on Google is absolutely amazing and is a great opportunity to buy into this company, even though they're sitting very close to all-time highs. I think Google is going to be a dominant player in the tech sector for long into the future. I don't see any other brand knocking them out of their market leadership position across many different industries, and the growth of their advertising, their cloud-based systems, and their media networks has been absolutely phenomenal. And taking a look at the Morningstar report, the current estimated fair value per share for Google sits at $2,603. And compared to where they are today, that means Google is trading at a 9% discount from their estimated fair value, according to one of the most popular stock rating platforms in the industry right now. And if we jump over to Simply Wall Street, who, like we saw with Facebook, does a discounted cash flow analysis, they believe Google is 36% undervalued at this current point in time, and their estimated fair value per share is at $3,729. So of course, like we saw with Facebook originally, these two platforms use different metrics to determine an estimated fair value, but both companies are showing that Google and Facebook are both extremely undervalued at this current point in time. And Google, even though it's one of the largest companies in the world, they continue to perform extremely well. And over the latest quarter, their total top-line revenue grew 34% year over year, which was absolutely insane. And taking a look at the numbers, in a 1 quarter, in a 3-month span, they generated over $55.3 billion of total revenue, and EPS came in at $26.29, crushing the expectation that was set at $15.82. And of course, their cloud revenue came in just shy of the expectation of $4.05 billion, but still saw some tremendous growth over the prior year. And one thing we're going to mention is YouTube later on in the video, who generated over $6 billion of revenue from YouTube ads in the first quarter as well. So overall, Google posted a very strong quarterly report, incredible numbers, and double-digit revenue growth of 34%. And we can see that their advertising revenue is still expanding year over year and is sitting at all-time highs. So even throughout a global pandemic, when many companies were worried that advertising was going to go down, that Google wouldn't be able to compete with Facebook, and all these different factors that would hurt the company's top and bottom line, none of them really came true. And we can see the past 2 quarters of over $40 billion in advertising revenue each quarter has been absolutely phenomenal. And their ad revenue growth has accelerated over the past 2 quarters as well. And although Google is already one of the most powerful companies in the world, there's 2 main business segments under the Alphabet umbrella that I believe will allow them to continue to grow to a much larger size. And first, it is their Google Cloud. So of course, the cloud network is growing dramatically year over year, and Google is one of the key players in that industry. And right now, they have some of the largest and most powerful companies in the world using their Google Cloud service to run their everyday business. We have companies like Walmart, Salesforce, Lowe's, AT&T, and many more choosing Google to power their cloud systems. And going forward, the revenue generated from these cloud networks is projected to accelerate and one day may become the leading revenue generation activity under the Alphabet umbrella over the next decade. And we can see over 2020, the total revenue generated from cloud grew 46% year over year, which is absolutely phenomenal. And every single year, over the past 3 years, we have seen some incredible growth rate, and it's more than doubled from the 2018 number. In the second big category, I believe people are undervaluing when discussing Google is actually YouTube. The platform that you're watching this video on right now, I believe will be much bigger in the future compared to where it is today. It's already the #1 video platform in the world, and I still believe that it's nowhere near its full earning potential for the company. Video content is here to stay. Video content is growing in popularity, and more consumers prefer video content over any other form of media. So the fact that YouTube is #1 in that specific space with growing demand will allow them to continue to grow for many years going forward. And just taking a look at the numbers, in the first quarter, YouTube generated over $6 billion of revenue in advertising for Google. And that was a growth rate of 49% over the prior year. And what's incredible is that YouTube can actually rival Netflix in total revenue by the end of 2021. If its current growth continues, YouTube will generate between $29 and $30 billion in revenue over this full year. And in the same period, Netflix expected to generate $29.7 billion in revenue for 2021. So over this calendar year, YouTube could generate as much revenue as Netflix, who as a standalone company is worth over $200 billion. And Netflix spends $17 billion per year creating content for their platform. YouTube is a user-based platform where creators like myself bring the content to the platform, and they're just a host site to bring the content to the consumer. So YouTube, although they are creating their own shows and different services, is not spending $17 billion to create content to generate the $30 billion in annual revenue. So I actually like YouTube's models better because I think it will always lead to opportunities for everyday individuals to create content and publish them to billions of people. So I think going forward, YouTube will surpass Netflix in revenue. I think going forward, the company and the platform can become more sustainable because they have access to way more creators and more users to put content on their system and are not so reliant on the capital they have to make new shows like Netflix is, and then have a budget of $17 billion in spending just to create new content to keep users entertained. And once again, with YouTube, you don't have to pay for it. It's a free service and you have to watch ads. Netflix comes in with a monthly subscription. So two very different models of conducting business to generate the same amount of revenue throughout 2021. So again, YouTube is a second key area of Google's overall business that I think investors are undervaluing. And when you put the numbers compared to Netflix, who as a standalone company is one of the largest media platforms in the world, the numbers are pretty equal. And I think going forward, YouTube will surpass Netflix. I think it's inevitable. And I think over the long term, the platform should continue to grow. And now we're going to take a look at Google's incredible financials. And I think out of all the companies in the world, Google has to be in the top 2 for best financial statements. Starting off with the income statement, every single year, total revenue continues to grow to over $196 billion in the trailing 12 months, which is absolutely insane. And for a company this large, they've more than doubled their total revenue in the past 5 years. And with just over $196 billion of sales, they have profits of over $51 billion, so a net margin above 25%, which is incredible for such a large company. And just think about that. In the past year, Google has locked in $51 billion of profit, of net income coming into the business, which is absolutely insane. And jumping over to the balance sheet, currently they have $135 billion worth of cash, sitting on hand. So they can do anything they want. They can make any acquisition. They can buy out companies. They can do research and development. They have so much cash on hand, they're in a very strong position. And if we take a look, total current assets of $172 billion versus short-term debt of only $55 billion. So once again, a current ratio above 3 and very sustainable. And one thing I like about Google is they only have $97 billion of debt on the balance sheet. Total liabilities of $97 billion. And similar to Facebook, they have so much cash that with their $135 billion cash pile, they can pay off every single dollar of debt and still have close to $40 billion of cash on hand, which is absolutely insane. And of course, taking a look at equity, continues to grow year over year to $230 billion sitting on the balance sheet right now. And of course, taking a look at the cash flow statement, the third and I believe one of the most important financial statements, because we can see every single year, YouTube has done a fantastic job of growing their cash flow. Google's cash flow from around $23 billion 4 years ago has now grown continuously to over $50 billion in the trailing 12 months. So for a company who does not pay out a dividend, $50 billion of cash flow coming into the business will allow them to pay down that debt, do research and development, expand their operations, and allow Google to remain a leader in the tech sector for long into the future. And of course, like we did with Facebook, to wrap up the analysis, taking a look at the future growth expectations and also forecasting 21% annual expansion every single year for the next 5 years going forward from Google. And right now, the stock currently trades below the 12-month expectation of $2,380 compared to the average estimate of over $2,700 per share. And the stock is considered a slight strong buy, coming in at a 1.7. So Google is the second big tech company that is considered undervalued or cheap, according to Morningstar and Simply Wall Street. They have a ton of growth potential going forward. Cloud, YouTube, and many other areas of their business are growing. Their ad revenue is at all-time highs, and I think this is just a company that will continue to dominate the industry for many years to come. I don't see any young tech companies available on the market right now that can even challenge Google with their size, their dominance, and their market-leading products across multiple different industries. So definitely a second big tech company I believe worth taking a look at for your portfolio if you want to get exposure to some big tech names that can withstand inflation, highly profitable, great balance sheets, and will continue to dominate through an inflationary period. So now we're going to wrap the video. I want to thank you for watching to the end. Please hit that like button and subscribe. I am the Jonesy Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.